up and running on Facebook here. All right, here we go, guys. So welcome to our Friday night wealth creation course. We're here live once again from beautiful Tampa Bay, Florida. It's about 10 p.m. my time. I'm excited that you guys are all tuned in. If you've never seen our videos before, every Friday we do something called Finance Friday. And so Finance Friday, the purpose of it is to spread the truth about money. Okay, the truth about money, the truth about economics. Tonight, specifically, we're going to talk about economies and economics. But this is information that for me growing up, I didn't have, right? A little bit about me, you know, I grew up in a family that lived in the poverty income thresholds. We weren't, you know, we didn't have money. Money was not a topic. It wasn't a conversation we had. There was not education on it. And so because of that, personally, for me, I struggled a lot with finances. Growing up, it was a topic of resentment, a topic of, you know, pain, trouble, strife, everything you could imagine. My parents got divorced over it, right? I was homeless because of it several times. And so, you know, I got to the age where I realized that this money thing was not going to go away. Okay, who's ever had that realization where you're like, you know, I wish that I didn't have to go to a job, but I have to, right? Like until I'm financially free, I have to go to a job to earn income because that's how life works and I have bills to pay. And so we all end up in this involuntary system of economics, right? And I want to define what that means here tonight and really go over the basics of it. Now, for some of you, you've tuned in with me. We've been going strong every week now with these free courses every Friday night for over 3 years now. Okay, over 3 years, we've not missed a beat every Friday for 3 years, more than 3 years actually. And that's impressive when you think about it. But I want to validate and welcome everyone that's back again this week. To see people that are consistently investing their time on a Friday night is just incredible to me. You know, it shows how much this matters. Now, tonight we're talking about the basics of economics, okay? And I want to just lay down a couple of ground rules before we dive into this. Same thing as I say every week. Number one, we're here because we are producers, not consumers, right? And there's a balance. You're going to consume my information and my content, what we're talking about, but I want you to do it from a productive state of mind. I want you to be engaged. I want you to be asking questions. I want you to think about application of the information and how you're going to apply it in your life successfully. Okay, so be a producer, not a consumer, and make sure you've got that mindset. The other thing is, you know, especially on the topic of economics, there's this complexity that happens with finances, right? Let me see if I can score some water. Could you give me some water? Thank you. There's a complexity that happens with finances where, you know, there's lingo, there's vocabulary, there's terminology, things that make it seem a lot more difficult than it is. And for some of us, especially for me at a younger age, that was discouraging. I would hear words that I didn't understand, and I was like, well, I don't know what that means. It must not be for me, right? It must be for the successful people or the sophisticated people, not for, you know, a lower class person like Jerry Fetta. I don't want you to have that mindset tonight. So if you have a question, ask. If I say something that doesn't make sense, ask. I'm going to do my best to keep things really simple. But the truth of the matter is because of the way the financial industry works, some of it's not simple. You know, all the basics are sure, but some of the vocabulary, the terms, the finance world doesn't slow down for us just because we don't know the lingo. So I'm going to try and bridge the gap the best I can tonight. But I need you to be on top of the game of, okay, if I don't understand something, I'm asking questions, I'm looking up words, and I'm making sure that I'm not getting left behind. And then finally, we will do our live. As always, we're going to go live and answer questions. So if you have questions, leave them in the comments. We'll answer those at the very end live on air. Now, this topic of economics, I want to actually give you guys the definition of what this means. Okay, economics. Okay, so this is a noun. The science that deals with the production, distribution, and consumption of goods and services. So it's the material welfare of mankind. The other one is financial considerations, which is kind of a poor definition, right? But it's talking about production. It's talking about, you know, bringing forth, creating things, entrepreneurism, you know, actually like value that's being produced, and then distributing it and making sure that it gets out into the hands of the people in that economy. And then the people consume those goods and services, right? So we have to have production, we have to have distribution, and we have to have consumption. And that's really what they're defining as economics. Now, if you go to the origin of this word economics, it originated in the late 1700s. It actually pertains to the management of a household, right? And actually, this goes back to 1585. The origin of this is 1585 for the word economic. It's a Latin word which comes from a Greek word which relates to household management, right? So within an economy, there's what's called macroeconomics, really big picture, right? Worldwide, global, countries, right? And then there's what's called microeconomics, which can be states, it can be boroughs, it can be cities, it can be all the way down to the individual household, right? And so when we hear economics, we usually don't think of micro. We don't usually think of my house, my neighborhood. We usually think of the country, right? Or the city or the state and its bigger picture. But I really want to set the stage on these fundamentals that we're going over. They're going to help you discern the macro, the big picture, and look around at you in the country and in the world around you and understand more clearly what's happening. But they're also going to help you drive better, right? Like you're actually going to be able to look in your own finances and say, okay, this is how I can better manage my own household finances, right? There's a reason why it's called personal finance. So without further ado, we're talking tonight about the fundamentals of economics. Now, the definition gave us some really clear points to start with. Number one is we have to have production, right? We have to have production. And I'm going to kind of draw these out a little bit as we're talking tonight. So we have to have production in economics. And the basis of that production should then turn into distribution, right? So we have to have, a good, a service. Let's say that I own a market, right? Let's say that I own a market. In that market, I have goods and services that have been produced, right? There's going to be fruits, there's going to be vegetables, there's going to be breads, there's going to be garments, there's going to be all sorts of things that are produced and they're brought to that market. Now, there also has to then be distribution, right? The market itself is the distribution source, right? So we have, tables and booths and everything set up in this market. That's where these products and services then get distributed. And then that has to lead to consumption, right? So I actually have to have an end user, consumer, somebody that's going to pay for the goods and services. They're going to eat the bread, they're going to eat the fruit, they're going to eat the vegetables, they're going to wear the clothes. And all three of these things are necessary for an economy to work, right? I could apply this to my own personal household, right? If I say, okay, well, I need to earn an income. I hear this all the time. How do I increase my income, right? Okay, well, first I have to have something valuable to produce, right? Like I have to have a skill or a product or knowledge or something that I can produce. I then have to distribute that production, right? Let's say that I'm really, really good at fixing cars, right? In real life, I'm not actually. I'm terrible at it. That's where my boy Sean King might be able to help us out. I can't tell you anything about your car, but let's say theoretically, I'm really good at fixing cars. I can produce that skill, right? But that skill is only valuable to another person. I can't make money fixing my own car. I can maybe save some money by fixing my car or changing my own oil, but that doesn't bring income into my household. So I have to distribute that production and somebody has to consume that production. And then we have this flow of one way here, the production moving down the line, and the other way here, right, we then have currency flowing down back towards me. And that's where this exchange starts. This is one of the most basic fundamentals, right? Because what happens is if we take production out, we can't distribute and consume nothing. You guys see that? Like we have to have it. Let's say we take out distribution, right? We take out distribution, we get rid of that. Well, we can't have production and then just consumption by osmosis. Who's gonna hear about the service? How are they gonna hear about it? How are they gonna get to it? How are they gonna receive it? Right? So we have to have distribution there as well. And then if we were to take out consumption, we have production and distribution, but we don't have anyone to actually receive it. Okay, and so this is one of the fundamentals of economics. And if you can understand this, this kind of gives you a way to almost set up like mentally a conveyor belt, right? And so you can see in a company, in a household, in a country, when one of these things gets mixed up or out of place, or it's stopped or it's halted, you're going to start to see a dwindling in the ultimate growth of that economy, right? Let's look at the United States right now. We had last year, production dropped, right? Because we couldn't go to work, we had to stay in our homes. Okay, so distribution dropped also. We went to various online sources, but people couldn't go to stores, they couldn't go to retail. And so because of that, consumption drops. Okay, around this time last year, the savings rate in the United States was at an all-time high, right? And that's good, right? We want to be saving money, but for the economy, what happened? Things tanked. The stock market crashed, right? The gross domestic product of our United States government crashed, right? And so we look at this conveyor belt, and it has to be in place. So all three of these elements need to exist. Now, this is kind of our baseline, but it leads us really nicely into the topic of supply and demand. Right? And this supply and demand concept fits inside of this cycle of produce, distribute, consume, right? So on the cycle of supply, right? For me to understand an economy, I have to understand what is being supplied. Right? What are the goods and services that are being produced? And that's really the supply side of things, right? Production and distribution tie into the supply. The demand is the consumption, right? What's being consumed, and that's what the demand is. And so inside of an economy, there has to be this equation, and both sides of this have to meet together. If I'm producing or supplying something that's not in demand, the consumption factor won't be there, right? And so there's going to be a component of, is there actual consumption and people to consume, but then also, do the people like consuming what I'm supplying? Because if they don't, I can supply and produce it all day and distribute it all day, and they could be there to consume it. But if they don't like it, if it's not meeting their needs, then that's not going to be something that works, and the production eventually will be in vain. You know, this for me is kind of the beauty of the economy, to understand the fundamentals of it, right? We have to have this in. And so if I want to, let's say, make a lot of money, I have to understand what is the demand of the community around me, whether that's online, whether that's in my city, whether that's in my state, right? And then I have to be able to supply that demand, right? Or vice versa. Let's say that I can't meet that demand, or maybe that demand's already being filled. I need to be able to supply something else. And then I need to be able to create demand for it. That's called making a market. I do that through, you know, surveying and promotion and advertising and marketing in order to create want for the thing that I supply. But I want to point out that there's so much control on this, right? So if we look around us today, right? If we look around us today, what are the things that are in supply and what are the things that are in demand? And where do you see differences? Right? We look at something that's in demand this week, gas, right? Gas, people had a high demand for gas. The reason why? There's a bunch of media and panic, and there was some kind of a malware or whatever happened, and the gas prices went up, and people said there's a gas shortage. So the supply of gas dwindled, the demand of gas increased, and so the price of gas increased as well. Right, and this is where we start getting into pricing. Okay, like all of this like leads into, yeah, there's action of produce, distribute, consume, but also the supply and demand factor is going to manipulate pricing. If it's vice versa, right? Let's say that the demand is really low, but the supply is really high. Prices are going to drop because nobody wants the thing. And so for me to be able to sell the thing, I've got to lower the prices because it's not actually considered valuable to those that are purchasing it. So they're not going to pay premium prices for it. Right? Let's think about something maybe that fits into this category right now. Like, what's something you could buy dirt cheap right now? Okay. I haven't been to the store myself in a while, so I don't actually know the answer to that. But if you think about this, right, that's going to cause the prices to go down. And then that's going to basically give you an oversupply, and it'll continue to happen. Now, this is one of the first rules of economics, is the supply and demand factor. What this will tie into, and what I want to bring up next, is the topic of inflation and deflation. Right, so we have this up here, we have produce, distribute, consume, which led us into supply and demand, which then leads us into something called inflation and something called deflation. Right, so inflation, let's break that down and tackle that really quick. From the outside looking in, inflation is going to look like prices going up. Right now we're in a period of inflation. Gas prices are going up, grocery prices are going up, lumber prices are going up, goods and services all over the place are increasing in price. That is inflation. Okay, now the opposite of inflation is deflation. Right, deflation is when prices drop. Okay, and so this would be tied to, in part, this supply and demand factor, right? So we said when there's a greater supply than there is a demand, prices are going to go down, right? When there's a greater demand than there is a supply, right, prices are going to go up. Okay, so the demand factor can drive it, the supply factor can drive it. But when we see this happen with inflation, and this inflation can happen on a micro level in my own household, right? Same with deflation, right? So I can be seeing that on a small level. I can be seeing that on a big level, like countrywide. The United States might experience inflation, right, or deflation. But the basics of inflation and deflation come down to this, right? When there's inflation, there is more money than goods. Think about this like a pool, right? So we have a giant pool of money, and then we have goods and services, right? If we had lots and lots and lots of goods and services, like they were little buckets, right? We'd be able to fit a lot of buckets in a pool to fill up water. And each of these buckets would be able to hold less because we have so many buckets, right? So the more buckets, the less water each one's going to hold. Right, that's an example of inflation. We have more money, lots of supply. In this case, the supply is the money itself. Then we have actual goods and services. And so when we take those goods and services and divide them into the supply of money, we get really high prices. We've talked about this before, the numerator and the denominator, right? The thing that we're dividing and the thing that we're dividing by, right? So in this case, the money itself is the numerator. It's what we're dividing. And then the denominator is the goods and services, the thing we're dividing it by. So if we take all of the money in the world and we divide by the amount of goods and services, we're going to get a price per unit. And in ratio, in relation to another price per unit in a given period of time, that's going to tell us whether that price per unit is higher than average or whether that price per unit is lower than average. And if it's higher than average, we have inflation, more money than goods. Okay, which means that deflation is the opposite. Right, deflation is when we have more goods than money. Okay, so I want you to think about how this plays out. When there's lots of money, we spend easy. We spend easy, we borrow, right? And so we have the effect of when we spend, borrow, and spend and borrow, like more transactions happen. There's more flourishing, there's more prospering, prices start to go up. That's inflation. Deflation, there's a lot of goods and services, but there's not a lot of money out there being spent. And so in order for the goods and services to start moving, prices have to come down to get people to spend, right? And so what's the result of that? If I own a business and I have to lower my prices in order to get customers in, that means that I'm making, number one, less revenue, right? Number two, it means that I'm making less profit when I sell a good or a service, which means that I don't have as much money for advertising. I don't have as much money for space. I don't have as much money for employees, right? And so in an inflationary environment, it's like the roaring 20s, right? Like it's just ramped up. Everything is pumping. Everything is going great. Deflation is like the Great Depression, right? We've got bread lines, we've got people that are looking for work, and it's a very stark comparison. But this is again tied to production, distribution, and consumption, and supply and demand. And then these factors trickle down into inflation. Okay, now the other aspect that I want to cover tonight is price and value, right? I wrote an article on this today. Okay, and a lot of this, like production, distribution, consumption, supply and demand, inflation, deflation, we've been talking about this tonight in terms of goods and services, right? We've been talking about the market, and we've been talking about food, and we've been talking about clothing and jobs. And all of that applies, right? Same thing with price and value. Price and value apply to all of that. But price and value specifically, they also apply to investing. They apply to assets. Same with everything else we've covered tonight. With investing in assets, if I'm going to invest in something, it's going to have production, distribution, and consumption. There has to be a balance between supply and demand. I need to understand whether it's in inflation or whether it's in deflation. I need to understand the difference between price and value. Okay, now I'm not going to explain the price and value yet in terms of investing in assets. I'm going to explain it first in terms of goods and services, because I think it's easier for us to understand, right? So this might sound very basic, and I want to cover this very clearly tonight because I firmly believe the average person does not understand the difference between the two. And that's not a ding on anybody here. That's not a ding on the average person. I think that we've been convinced that they're the same thing. Okay, and especially in the financial market, you buy a stock. How do you know the difference between the price and value of that stock? You buy a cryptocurrency. How do you know the difference between price and value in that? You buy real estate. How do you know the difference between price and value in that? See, a lot of people don't. They think that the price they paid is the value, and as long as it goes up, they got a good deal. Okay, but let's bring this back to things, commodities, right? So let's say that I am selling you an apple, right? Intrinsically, you know about what an apple is worth. And so if you came up to me and I said, hey, I'm going to sell you this apple costs $10, you wouldn't buy it, right? Why not? Because A, you have experience with apples. You've eaten them before. You know that they don't cost $10. Okay, B, you know that right now, even though they might cost a little bit more than usual, you can go buy it cheaper somewhere else. And C, you know that an apple is not that valuable, right? You're going to eat it. You're going to chew it up, swallow it, digest it. It's going to go out the other end and it'll be done. And it's not worth $10. And then you also know comparably, what could you do with the $10 with another thing? Okay. And so in this case, I'm telling you, hey, my apple costs $10. And you're saying, no, how about $2? Because you know the value of an apple, right? And that value of the apple doesn't change, right? An apple is an apple, so you can't convince me the apple is more valuable over time. You like, unless there's a scarcity of apples. Again, this goes back to supply and let's say the supply of apples goes really, really low and the demand goes really, really high. Then yeah, apples might pop up in price, but they're still worth the same apple. You guys see that? So same thing with like if I was selling you, let's say a house, right? And I was saying, hey, I'm going to sell you this house for 100 grand. And you know for a fact, and you've had it appraised at 200. You would be on that deal because you understand the house is worth more than it costs. Right? And the reason being is you can look at comparable houses around. You've lived in houses before, you've probably bought and sold homes, and you understand that, right? And so you can see that difference. And again, supply and demand might affect the price. Inflation, deflation might affect the price. But generally, there's going to be a very finite value placed on that home. Okay, because a home has intrinsic value, but also it can only do certain things. It's very definite in the amount of things that it can do and produce for you. Okay, so it's important to understand this difference in price and value. We've all had the experience of getting ripped off. Right, we pay money for something, it doesn't work, it's a bad deal, and we're like, man, we got ripped off. What does that tell us? That means that the price, right, the price here, let me erase my squiggles. The price here was higher and the value was lower. We've all experienced that. It's actually an emotional feeling. Like you're sour, you're upset when it happens. We flipped that. We've all had a great deal, right? Where we felt like we got a bargain and we got a steal. Vice versa. Value was higher than price, right? You're just like impressed. You're like, man, I can't believe that happened. So with investing, the same thing occurs. Same exact principles, right? So if I were to buy, let's say, a stock, and I'm not into stocks, but I'm just going to choose stocks for an example, right? Right, that stock has to have production, because what does a stock represent? A stock represents ownership in a company. It represents an ownership share in a company. So the company that I'm investing in needs to be producing something of value. It needs to also be distributing that thing of value, and there has to be a consumption of that thing being produced. There needs to be an equal balance of supply and demand, right? So I need to understand what is the supply and demand of the thing being produced by the company that I own, right? If it's a high supply and a low demand, this might not be a stock that I'd want to buy. If it's high demand, low supply, it might be good now, but when we run out of things, it might not be good, right? And if it's equal and I look at, okay, there's a good balance of supply and demand, and this is a long lasting and it's going to be there, this might be something I want to own long term. I also want to look at my inflation or deflation, right? Is the price high or is it low in relation to where it should be in relation to other things in the economy? Okay, again, we talked about inflation, more money than goods, more goods than money. With a stock, there could be more money than goods, meaning a lot of people bought shares and there's just not that much there. And so it artificially pumps the price up because all this money floods into it. Okay, similarly with deflation, there can be very high value stock, nobody knows about it, nobody owns it, so it's trading at a much lower price. Okay, and then the price and the value, how do I calculate that? How do I calculate value with something like a stock? Okay, because it's not an apple. I can't eat it, I can't hold it, right? I can't bake a pie with it. It can't give me vitamins and keep me alive. So how do I actually look at this? Okay, and so with something like an asset, we're going to look at track record. We're going to look at earnings. We're going to look at intrinsic value. And we are going to look at extrinsic value. And so I can look at these four things and I can relatively use that to come up with an objective logic basis of the value of the asset that I'm buying. Right? And the more of these that it has, A, the more substantiated and supported the value is, but B, probably the more valuable it is actually. Right? The longer the track record of a successful company, it's going to be better to invest in. It's more valuable. The higher the earnings, the better it's going to be. The higher the intrinsic value, the better it's going to be. The higher the extrinsic value, the better it's going to be. Intrinsic value, let me break these down too really quick. The difference here between intrinsic value, this is innate worth. Right? So like an apple has intrinsic value because you understand, like it's got, you know, like caloric value, it's got vitamins, it's got minerals, it's got fiber, you can bake things with it, you can trade it. So there's intrinsic value. Extrinsic value, this is more subjective. Right? Who's ever heard people say, well, the market thinks? You know, you'll hear stock people talk about, or Jim Cramer, like, well, the market thinks this and the market thinks that. He's really speaking to is the subjective extrinsic value. Okay, what is the popular opinion on the topic? Right? And so that's the difference between intrinsic, extrinsic. Like an apple, like we said, let's say it's worth $2, $3. That's its value, and that's intrinsic because of what you can do with it and what it has. It's really what it produces, distributes, and what you can consume, and that's what the basis of the intrinsic value. The extrinsic value is, let's say I collect apples, and I'm like, that's a one-of-a-kind Mount Fuji whatever apple, and so I decide that for me, it's worth $6, right? The difference there, that $3 spread, is extrinsic. It doesn't actually reside inside the apple. It resides inside my head. I think the apple is that. It doesn't mean the apple actually is, right? Now, the final thing that I want to tie into this tonight is an understanding of money and currency itself, right? So this is called money as a vehicle or channel. Okay, and this is money or currency, right? So depending on how we're looking at this, but all of the basics that we've talked about, like production, distribution, consumption, these are all about goods and services, right? Right. I would produce goods and services. I would distribute goods and services. I would consume goods and services. I can do that with assets as well, right? It's important to realize in the picture of an economy, currency, and also typically money, is simple representation of these things that are being produced and consumed. We've talked about before, it's just a coupon, right? Like we used to barter, we actually used to physically trade objects back and forth. But one of the economic fundamentals is we don't do that anymore. We have currency, we have green dollar bills and digits, and we trade those back and forth instead, and those represent the things that we're going to do with them, right? And so this entire cycle still applies. Everything we talked about still applies, but I want you to realize with money and with currency, it is a transfer mechanism, right? So we have here currency, and I want you to think about this as like a channel, right? Like a wavelength almost. And so I can send currency along this line from point A to point B. Okay, and so we have here at point A, this is the origin. And then point B, we have the receipt. We'll call this origin point and receipt point. Okay, now I want you to realize this represents a different person and this represents a different person. This is where it gets a little bit trippy. When person A looks at the money in the transaction, he is looking at what he's going to get. He's looking at the things he is going to receive when he gets money. So let's say person A here, the origin point is producing a good or a service. Let's say that he is selling, what is he selling? Let's say vacuum cleaners. He's a Kirby salesman. He's going door to door. He's selling vacuum cleaners. He's hustling it. When he sells a vacuum cleaner to get money, he actually sees in the money the things he's going to do with it. You guys see that? So he didn't actually see money. He sees what is he going to do with the money. We all do this, right? Now, person B, he's the one giving the money up, and he is seeing the things he is going to get for it. But both of them are seeing things. They're not looking at the money. They're looking at the thing that they're going to get in exchange for the money, or the thing that they're going to get in exchange for the value receipt. So when you look at a monetary transaction, it starts with a particle of value traveling along the channel of money and then turning into a thing. It starts as a valuable good or a service, and it turns into a thing or another valuable service, and it's really an exchange of those items. And so when we look at the cycle in the economy, like we take something like production, distribution, consumption, right? This guy over here is producing a valuable good, he's distributing it, and then this guy's consuming it, and the exchange that they're using to make that transaction happens is the currency in the middle, and that transaction travels along that line. Okay, it's very important to understand this. And so when we look at, okay, well, what are we getting for our money? This is where we start getting into price and value, right? We start getting into things like Keith says Kirby Rhino of the early 80s. My mom bought a Kirby when I was a kid, so that's why I thought of that. It was a great vacuum. I think she still had it all the way to the end. But when we look at things like the economy and you know, supply and demand, there's also an aspect of, do we understand what we're getting for our money? Okay, because if all of us are logical, all of us are educated, and all of us are smart, then yes, we're always going to get the best value at the lowest price. because we understand that it's not about the money, it's about the thing that we're giving up and what we're getting in return for it. And money is simply the middleman. But if we don't understand that, then we can easily be taken advantage of. We can overpay for assets. We can overpay for goods and services, right? And so this entire economy actually rests on the perception of what that dollar is going to mean for me when I earn it, because of what I'm going to do with it. And then also on the flip side, as a consumer, what is that dollar going to mean for me when I trade it, right? Because we have this produce, we have this distribute, and we have this consume. And person B is the consumer and person A is the producer. And both of us have expectations on what that money is going to mean for us, right? And so like for me in my life as a producer, I don't buy in a lot of consumption items. I'm not into, you know, flashy watches, fancy clothes. I could, but I would much rather buy assets. And so for me, the money means a lot more because it has a future value. When I invest it and it grows, that dollar is going to be worth $5, $10, or $15, right? And so it gives me a lot more urgency as a origin point to produce and get lots of currency back, to put out goods and things and services to earn lots of currency. As a consumer, it also puts me in a position where I really have to focus on, okay, well, this money has a future value, which means if I lose it or I overspend it, I'm losing something called opportunity cost. It's what could have been if I kept that dollar or if I invested that dollar, right? And so it puts me in a position where I have to really look on all my transactions. Am I getting the best price for the best value? And if I'm not, I don't do the transaction because I understand what I could be getting instead if I keep that dollar and invest it. Okay, which brings me back to the investing piece. In order to do that, I have to be able to apply all this to the investing world. Okay, I have to be able to look at, okay, production, consumption, distribution, supply and demand, inflation, deflation, all of these items as it pertains to investing, so that I actually know if I keep a dollar, it does have a future value. Because if I don't understand this stuff with investing, I keep a dollar, I might make a bad decision and it doesn't have a future value because I lost it, because I speculated it away, because I bought invisible objects, right? It's important to realize money represents things, which means investments are also things. I like gold and silver because it's a thing, right? It's a real tangible object. I like life insurance because it's a thing. It's a physical contract, right? I like real estate because it's a thing. I like private lending because it's a thing. I don't like stocks because it's not a thing. At the end of the day, it's an invisible nothing. I don't like crypto tokens because they're not things, they're invisible nothings, right? So for me, I take all of this stuff that we learned tonight as an investor and I apply it there as well. And that's why I said tonight, we're going over the fundamentals. There's lots of areas this can apply. This is a very broad topic, but I want all of us to be able to take what we learned tonight and say, okay, in my life, how can I apply this? Okay, how can I actually take this and do this tomorrow, right? So what I want to do is I'm going to open this up for some questions. And I hope we kept things nice and simple tonight. I'm going to open this up for questions. So if you have questions, drop them in the comments. We will go live and answer them. And I'm going to start here on Facebook. All right, good to see everyone on Facebook tonight. Let's see what we have here for questions. Jeffrey, good to see you. Sean, good to see you. Todd, good to see you. Sean says, I'm trying to learn as much about money as I do mechanics. Thank you for these courses. That's awesome. All of us should attempt to be professionals when it comes to the topic of money. Okay, Brad says, sounds good. That was the volume. Nano says, Kryptons. All right, we have a question from Avery. Let me bring Avery on live here. All right, we've got Avery live. How are you tonight, Avery?
Being well, Jerry. How about yourself?
Hey, I'm good. Thanks for asking. What's your question?
Yeah, I just wanted to know, where would stagflation come into play on an economic level?
Yeah, that's a great question. And really quick, I want to grab a definition for stagflation so that we all have this. So persistent high inflation combined with high unemployment. So it's a stagnant demand in a country's economy. So to give you guys a definition of that, stagflation means that we have inflation, right? Prices are going up. There's a large supply of money and there's less goods than the money, but it's saying that also there is high unemployment. So people aren't working. And so then we have demand also stagnant, right? So things aren't ramping up the way they should. We actually, in my opinion, are coming out of stagflation. We've been in it for probably the last year. So stagflation, let me graph this out and draw this out. So we have an element of inflation, right? Which is again, more money than goods. But also we have unemployment. And this is high unemployment, right? So either people don't have jobs or there are jobs and people aren't working. Sound familiar? And then we also have stagnant supply. Right. So there's an element here of something called monetary velocity, which is how quickly money moves. Right. So in an inflationary period, it's assumed that monetary velocity should be high. Like we said, when we all have money, we spend. We spend and borrow and spend and borrow. And the amount of transactions we do, the volume of that increases, and the amount of interval and time in between those transactions decrease. So we do a lot of transactions in a very short amount of time. And so the money really starts moving and it's a very high current, right? But if we have lots of money, but people aren't working to earn the money, right? Then they don't have money to spend because they're not working. And that can either be because there aren't enough jobs, which is typically never the case, or people don't have the skill sets. They're missing education, or they're missing motivation, or they have whatever issue that prevents them from working. And then we also have a supply that's stagnant, right? So the supply is not really doing a lot, whether increasing or decreasing. And so this results in stagflation, where we have almost elements of inflation and deflation pushing against each other. And it's just this weird limbo spot, right? And you guys may have felt this in the last year, where it's like, okay, we did stimulus, we did, PPP loans, we did EIDL loans. Why isn't the economy getting better, right? The stock market is, real estate is, right? But you look down in some of these towns and businesses are still closed. Unemployment is still high. Goods and services still aren't moving. People aren't spending. And that's kind of what this looks like. Now, I will add that in my opinion, stagflation does not exist outside of a government, right? Government manipulation, I believe, is the sole cause of stagflation, because in and of itself, an economy is production, distribution, consumption, right? Which means that there should be money, there should be goods and services, there should be jobs. If I produce something and I distribute it and it gets consumed, there had to be money made, right? There had to be goods and services passed, and there had to be jobs. And so those three things are organic. And it's when we start manipulating and artificially increasing the money supply and lowering interest rates and giving people subsidies and unemployment and this and that, and just getting in and meddling, that's kind of what creates stagflation. So I know that's kind of a long-winded answer, but that's a very kind of complex economic topic. I think it's a great question, though. Looks like Nano has a question. Let me bring Nano on live here as well.
Hey, Jay.
What's up, Nano? I haven't seen you in like an hour, man. We had pizza with
right?
Nano tonight.
Good. So I had two questions here. First one, in regards to stagflation, would that also correlate with depression, since it implies that less people are working, which means less money is moving around? So that's the first question. And the second one is, would the artificial money being made also correlate with financial slavery as well for the citizens?
Would it correlate with what?
With financial slavery.
I think I see. Yeah. So to answer the first part of Nano's question there, so stagflation, it will have some elements of a depression. Now, the literal definition of a depression is that gross domestic product is declined, I think, for, I believe it's 4 quarters, right? So it's going to be for an entire year. You have to see a decline in the actual gross domestic product of a country or of a nation, for that period of time. So that doesn't necessarily on paper mean that a depression is happening. But if you have a depression happening, like you look at the Great Depression, you look at the elements of it, right? Really high unemployment, there's supply shortages, people aren't working, there aren't jobs, like, there's bread lines, there's, less food on the table. Those are all like elements that you'll see in a depression, and you could see that in stagflation, right? So we're technically, in my opinion, in a stagflation now. We do have some of those elements, right? We have high unemployment, we have supply shortages happening. And so we have some of those things that would happen in a depression. Now, gross domestic products can be manipulated as well. And so that's where the government can print out money and make things look like they're better than they really are, which kind of leads into Nano's second question, which is increasing the money supply, leading to the slavery of citizens in that country. That's a definite yes, right? So the money supply is how much money is in existence in a country. And so when a government supplies more money to its citizens, AKA in this case, the United States government, they're actually borrowing that from a central bank, which is a private institution. And so they're creating debt, and the debt has interest, that interest has to get paid. It can only get paid through taxes, right? Or by borrowing more to pay the balance, which further enslaves the people. So it definitely does lead to financial enslavement for the citizens. And that's on an economic level. From a behavioral level, I want to say that it does that too, because it teaches us as citizens that we don't have to produce for ourselves, that big brother's always going to watch out for us, that we don't have to be good at producing things, and we don't have to learn how to distribute value. All we need to do is consume and then hope the next check shows up, when the next stimmy round comes out. So it's kind of like feeding wild animals. It's nice and it feels good to do, but you're also hindering that animal from being what it truly is, which is an animal that's independent of human beings and can go and hunt and kill its own. So to answer Nano's questions there, that's exactly what I think happens. Great questions tonight. All right, we've got another one here from Brad. Let me bring Brad here on live. There's Brad.
Hey, Jerry.
All right, we're live here with Brad. How are you tonight, Brad?
Great, Jerry. How you doing? Great show.
I'm good. Thanks for asking.
This course is very interesting because I've been thinking about this for a while. We have high unemployment, and the stimulus payments are being, given out like candy. And so, what do you think the breaking point's going to be in all of this? Because sooner or later, this is going to collide.
Yeah, that's a good question. So it's hard to say. It's all speculate, right? Because this is not something that's ever happened before. We have high unemployment, but it's not because there's lack of work, right? And so it's more people are choosing not to work because A, they're afraid, or B, they get paid more money to stay home, or equivalent amounts to stay home. And so I think what's going to end up happening is I think that, either prices are going to come way up, right? Because in order for me to buy somebody's labor, I have to be willing to pay them more. So I've got to be willing to pay them a higher wage than usual, which means that I ultimately have to raise my prices, which comes back on the consumer, and it leads to inflation. The other thing is businesses are going to say, fine, screw you guys. I don't want to hire a bunch of lazy bums anyways. I'm going to either economize and use systems and machines, or go overseas, or just reduce my operations. And it's going to cause deflation. And I think right now, Brad kind of hit it on the head. We haven't hit a breaking point of it going one way or the other yet, right? And so that's why it is a stagflation. If I were to guess, my guess would be that we're going to cause inflation. I think that we're going to go into inflation. Eventually, that'll be deflation next as a byproduct. But that would be my guess. For me personally, when I look at in my industry, if I look at someone that is saying, hey, I make $1,500 a month to stay home, so you need to pay me more than I'm worth, I go back to price and value, and I'm like, no, I'll go hire in Eastern Europe or the Philippines or South America, or I'll hire commission-only salesperson and let them kill whatever they want to kill and make as much as they want to make. So it'll be interesting to see how that pans out. That's a good question from Brad there. All right, we have a question from Jeffrey, he says, where is gold headed over the next year? That's a complete speculation. I will bite just because I'm a gold guy. I like gold. I know Jeffrey does too. I think gold will personally go up in price over the next year. Now, it may not, right? It has, I think in the last couple of weeks here, it's gone up by about $100 an ounce. I think it'll continue to trend upward. And simply because, the Federal Reserve, they're printing so much money. The United States Treasury is borrowing so much money that I think that'll drive the gold price up as people lose certainty. And I also think that we haven't seen the last of volatility for the crypto tokens. The idea that we're putting money into these and they're not actually being distributed, right? So we're sticking money into them, but they're not actually being used as currency. And so we haven't seen cycles of people putting money in and then pulling equivalent money out of those currencies or those tokens. And so I think the safe harbor of that is going to be a little bit more volatile than people are expecting. We'll probably see more head back into gold. I could be completely wrong though. And so for me with gold, I look at the numerator, which is an ounce of gold, rather than the denominator of what's the price of that gold. An ounce of gold for me is an ounce of gold. It always will be. And so it's simply something I want to own. And I know over time, if you look from 1970s till today, it averages 8 to 10% a year. It's got a standard deviation of anywhere from up 15% to down 15% from that number. And so I just kind of assume the trend is probably going to happen, and it may be that 15% up or that 15% down. I don't know, but over the long haul, I know that it will be 8 to 10% annual rate, and I'll still have an ounce of gold at the end of it. Awesome questions here. Let me see if we have any more here on Zoom. I do not see any more, guys. So that's it. That's all the questions we have. So what I want to do is I'm going to wrap up here. Thank you guys all for watching. Again, if you have tuned in for the first time, we do these every single week, free of charge, to share the truth about money. The stuff you learned today, take it for granted. It's on Facebook. It's free. But I want you to realize you won't learn this in college. You won't learn this in high school. You won't learn this in your Dave Ramsey classes. And so just keep coming back and keep revisiting and learning. If you would like to learn more about how to become financially free, okay, you can grab a copy of my book, Blueprint to Financial Freedom. If you go to jerryfetta.com/B2F, it's the letter B, the number 2, the letter F. I wrote an entire book on how to achieve greater and greater financial freedom in your life. I follow that plan myself. I've helped hundreds of clients do it. And so it's something that if you want to learn more about this in your free time, grab the book, go to that link, tune in again next week. That's all I've got for you tonight. I'll talk to you guys later.